Hi, I'm Keith McCullough, and welcome to the Hedgeye Investing Summit. This is going to be a dandy. We have a lot in store here. For the next 3 days, we're going to go back to back with different people that are competent in their realm, that have been accurate. Again, people that have a process that you're certainly going to be able to learn from. And again, as we get away from that old wall and we start to build our own process and again, be held accountable to that process and the views embedded in that process, I think that you'll find that the people that we have are the right people to be listening to. So without further ado, one of the top guys that I know out there and have known for a long time, I've been fortunate enough to have known Daniel Lacalle for quite some time. He's always one of the best choices if you want to lead off a global macro discussion and you want somebody to be able to knock down the pins one by one from China to Europe to the US and back again. Daniel, thank you very much for spending some time with us in the first slot. I very much appreciate it.
Thank you so much. It's an absolute pleasure, as always, to be in such fantastic companion and, a true honor.
Yeah, it's a good day to not be a macro tourist, my man. So there are a lot of people out there that have a lot of opinions that are more touristy in nature. And what we mean by that, for those of you that don't know, are people that don't have a model, don't have a process, and they just have views on what is happening in places like China and Europe. But Daniel's not that guy. He's, of course, the chief economist at Tressis, and he's written extensively on these matters. And again, he writes daily. If you don't follow him on Twitter, you absolutely should. But maybe if you just take a step back, because what I'm going to try to do in the next 3 days, Daniel, is capture the cyclical component, like where are we in the cycle, which is the most important thing. As you know, from my perspective, in rate of change terms, where are we in the cycle? And then wrap around that with the long-term views, which you've done as much work as anybody that I know, those longer-term secular issues. Because if we indeed know where the cycle is, we can see where those longer-term issues may or may not matter as much to markets. So maybe if you take maybe the global cycle first, and then we'll jump into different countries.
Certainly. The global cycle is in the face of what I have called a number of times debt saturation. So what we are seeing is a prolonged recovery, but that recovery, what it leads us to much lower growth than what we're used to. And certainly what we're now is in the face of slowdown. We're in the face of slowdown because after years and years of stimuli, what we're seeing right now is that the evidence of lower productivity, higher debt, and the challenges of the demand side policies that have been implemented and the failure of many of them are driving lower levels of growth. And I think it's pretty evident in those economies that have relied the most on monetary policies compared to, for example, fiscal policies. So it's quite evident in China and very, very evident as well in the European Union.
Now, if you take, let's take the big one that everyone, in particular the tourists, like to talk about, which is China and this wonderfully beautiful, very good deal. However, we can describe it with more adjectives, of course. But again, is the Chinese slowdown having everything to do with trade wars or not?
It has nothing to do with trade wars. If you look at the downgrades of consensus estimates, the downgrades in industrial production, in gross capital formation, the constant devaluation of the yuan that we have seen at least in the last 3 years, all of those things, and obviously capital controls implemented by the government, all of those things point to the reality of a slowdown that has absolutely nothing to do with trade wars and a lot to do with the concept that we mentioned before: debt saturation, excess capacity, a lot of malinvestment directed by government policies and regional government policies. So it is simply the realization that all of those different projects that have been implemented virtually actually since 2008, all those big stimulus plans have driven the economy to be less dynamic, not more. And the trade war is simply, I would say, an excuse to justify the evidence of this weakening of both internal but also external demand. Remember that except for the United States and a couple of other countries, China now is a trade deficit country.
It's amazing to watch the external demand component, like some of these data points, even exports, which had been a long-standing growth story for the Chinese, down 20% on a year-over-year basis. Some of these numbers, Daniel, I wake up in the morning after you do, because you're in a different part of the world, but my jaw drops sometimes when I see some of these numbers. As you know, the Chinese make up half their numbers, and they still are putting up, even if they're made up numbers, horrendous numbers in rate of change space.
Absolutely. And I think that is the critical part, is the rate of change. The China bulls will always adhere to the idea that, the growth is still phenomenal, but it's only on GDP basis. If you look at, and obviously we know how the GDP can be played with, particularly when the economy is controlled by one single entity, the Chinese Communist Party. But if you forget GDP, and if you look at industrial production, if you look at exports, exports are a very important driver here, because they are also showing that the economy, and particularly the capacity of the economy to be more competitive, is actually weakening quite rapidly. And I think that the model change that was used many times by some of the China bulls as an excuse for it, we are going from the old economy to the new economy, has actually it is a complete farce in terms of an excuse, because the reality is that the Chinese government continues to defend, and very much so, the alleged old economy. The state-owned enterprises have been the main drivers of increase of debt. If you look at the Hang Seng, you can see that the earnings of the companies show that the vast majority of the companies generate returns well below their cost of capital. Private indebtedness is growing. Inventories, also another figure that you talk a lot about. Those show that the economy is not as robust as the government would like us to believe. Obviously, think about it. That just sorry to interrupt. You would not have a robust economy and the need to implement stimulus after stimulus, devaluations, and implement capital controls. Obviously.
Yeah, obviously. Now, this chart, which I think you're probably familiar with, slide 118, guys, in the macro deck currently, we're showing what actually brought China to look like they were accelerating on a fundamental basis. I mean, it absolutely did. If you go back to the Chinese stimulus within the Shanghai Accord coming out of the 2015 slowdown, what you see here is secondary industries in China, which again, this is the old China, or the heavy industries, empty cities. They're not obviously all empty at this juncture, but they certainly aren't full. But again, these types of industries had a massive ramp coming in, and that's the blue line in this chart, where in the middle of 2016, the Chinese stimulated like mad into easing base effects. Now, the base effects, Daniel, are at their steepest point. The data is at its weakest point against those steep base effects. I get a lot of questions about this chart because some people think, me included, like the worst of the slowdown may be in the next couple months, because that's just the toughest comparison. What do you think about that as we go into the back half of the year? The Chinese stock market is trying to signal, even if they're not doing it themselves, the communists themselves aren't centrally planning it up into the close every day. I have my doubts about that. But again, what side of this do you sit on? Do you think that the worst of the Chinese slowdown, which is now 2 years in, by the way, in rate of change terms, is behind us, or we're about to enter a much bigger secular and structural problem with long-term growth?
Yes, I believe that the worst is actually in front of us.
Really?
And it is,
wow.
We will probably see a small bounce, a technical bounce. You know this very well, that after the Chinese New Year ends, and then some of the restocking and inventory playing around is moved here and there. You see a small bounce, and everybody talks about the trend changing, and then comes June to August. Those are the months to fear in Chinese terms, because that's when things are likely to turn sour. Remember that the reason why the stock market in China is rising so dramatically is first because of this magic belief on the trade deal that is going to solve everything and change the trend. We have discussed this numerous times. The trade deal is going to be, yes, it will happen, but it will be about things that are on the margin. And more importantly, it will probably mean that China will import more of some products from the United States. However, that will be a zero-sum effect that will definitely reduce imports from other countries, particularly emerging economies. So what it does not mean, and it will definitely not mean, is a big change in the trend of growth. So I do think that we are likely to see the worst in front of us, the reason being that the Chinese government made a huge effort into the end of the year to pump up the figures. Mm-hmm. And if you remember, there were massive liquidity injections at the end of December, beginning of January. Those liquidity injections have probably transferred into higher credit. Well, not probably. Credit growth is a double digit in January. So we will likely see those components of GDP that are pumped up by debt play a little bit in the favor of the data at this in March, maybe April, but then it fades away.
If you're right on that, I mean, that's got to be one of the biggest calls to make from here. Most people that I meet with, and you meet with them too, institutional investors, are constantly looking for what could go bullish, and they're constantly looking at the place that was bearish. Now, having been a China bear for a year and a half now, I don't have that concern. I do concern myself with missing major market moves, which I'm currently missing one in the Shanghai Composite Exchange. But I have other things to do with my life. I mean, especially if you're right in the next 3 to 6 months. The way I'm going to deal with it is I'm going to wait and watch, because if you are even remotely right, this thing is going to collapse on itself again, and there's really nothing that they can do, incrementally speaking, relative to what they've already done. So that, to me, let's just check that as topic one. I want to spend 10 minutes or less on that, and let's go right to the wood on Europe. Like the European slowdown. Again, Europe, I've been bearish on Europe for a year and a half. No, I've not been buying stocks because they're cheap on the wrong numbers. Now, again, I'm in the same spot. I got European equities rallying. I got headlines from the ECB today, or somebody sniffing around saying that they're going to buy stocks. The European slowdown, can you give me the economic view first, and then we'll talk about the market transmission mechanism that's currently or not underway?
Yeah. Well, the reason for the Eurozone slowdown is reality versus magic. You can't expect. We have been very, very. It's been very frustrating to deal with European bulls that felt that the economy was going to grow 2.3, 2.4% in an aging population, massive government spending, huge tax-rich economy. It's not going to happen. And I remember discussing this at the ECB and telling them that I was extremely worried about the fact that 80% of gross capital formation was actually a recycling of capital, and that therefore you could not expect productivity growth, improvement in the underlying economy, and real wages fundamentally getting stronger. No, they didn't even know that, and they didn't even knew how to deal with that figure. The point about the Eurozone is not dissimilar to that of Japan in the end of the 80s. What happened with the Eurozone is that it disguised its structural problems with liquidity. And that generated a placebo effect. Of course it did, because one of the big drivers of the crisis was the fundamental belief in the risk of the euro collapsing. So once you got that out of the picture, that definitely created inflation in financial assets. And you have today negative yield in bonds in almost all of the economies in the Eurozone. And massive inflation in sovereign bonds, but that has not transferred. The chain of transfer of monetary policy has not gone to the real economy, as the ECB, as the central planners expected. Hold on, it has obviously generated a transmission into the real economy, but definitely not the way that central planners expected. And the reason for it is being that the vast majority of the liquidity has gone to defend current spending from governments that are massively increasing imbalances. No, So the issue of the Eurozone is very simple. The Eurozone is missing the technology revolution completely. You look at the United States, you look at China, you have the largest technological companies all over the world, yet in the Eurozone, you only have about 4% of the stock 600 is in technology, and it's very questionable to call technology some of those companies. Yeah, it's true. I'm sorry. You sometimes need to put some companies in sectors that they don't belong to, no, in order to at least make them seem relevant. So whilst in the United States you have in the S&P 500 around 25%, I believe it's now, in technology. In the stock 600, as I said, you have about 4%, and many of them are not even technology. So the Eurozone is missing the technology revolution. It's not addressing the issues of productivity because it continues to subsidize the obsolete sectors and penalize, particularly through a very aggressive fiscal wedges, the sectors of high productivity. And on top of it, you have the problem of demographics that you and I talk about all the time, and that the central banks always ignore. And finally, with it, the problem of a high debt because of also very, very high government spending.
It's the long-term case for me is very easy to understand, if only because I listen to you on this subject a lot. But you just can look at the numbers. I mean, the facts bear themselves out in spades, particularly the closer you get to demographics. But on the cyclical point, I guess it's the same question as China, and it's really interconnected to a large degree. Like, Germany needs to stop slowing now. In my model. And because they were slowing at this time last year in rate of change terms, on slide 39 of our macro deck, for people that aren't familiar with quads 1, 2, 3, and 4, we've really been in this across Europe, Daniel, as you know, with Italy being in a recession. Obviously, it goes from quad 4 and into quad 3 and then remains in quad 4. That's how you get a recession. France is entering recession. But my model's like teasing me here, Daniel. It's like, could we be coming out of or could we start to show an L-shaped recovery, I think is how Darius would put it, in Germany, and will that lift Italy out of its current recession or not? And by the way, if it's going to happen, it's got to happen in the next 1 to 2 quarters as well. So it's almost the same question in terms of timing as China. Yeah,
you will likely see a small bounce at the beginning of the second quarter, definitely. Reason being that the components of both government spending and the external sector being actually not that bad, because yes, exports are falling, but hello, imports are falling as well. Therefore, you get to that amazingly ridiculous position in which the data actually looks good because the countries are importing less, which actually should be a driver of higher growth in the future, isn't it?
Yeah.
So the point that I'm trying to make is that you're absolutely right, is that Germany really needs to stop slowing down. But Germany is not going to finance another crazy bonanza of the peripheral countries that ultimately will end in a bigger crisis. And the reason why it's not going to do it is because it is already doing it. And this is the critical part that nobody seems to want to understand, which is that it is not that Germany is underspending and saving too much. This is that Germany is actually spending quite a bit more than what they need. And that is very evident in inventories, no? And that is very evident, for example, in some of these top industries when you look at, working capital build, etc. So there's no evidence that Germany is underspending, as we mentioned before, and there is certainly absolutely zero evidence that if they started to spend dramatically would cause big improvements in the economies. Think about this. If Germany doubled its imports from Greece, Spain, Italy, and Portugal in the next year, the overall impact on GDP growth in the European Union would not be more than 0.1, 0.2%.
That's terrible.
So, and that's double. And that is obviously not going to happen in an economy that is slowing down due to many factors, including, and we forgot before, is how aggressively energy expenses have increased in the Eurozone. The policy of the German government of getting rid of nuclear has been a disaster for the consumer. Bills have more than doubled. That is a problem that is happening also in peripheral countries that went crazy with subsidies for renewables, etc. And we forget that the Eurozone is in the middle of another wave of these green plans. No. So what you will likely see is a technical bounce, because the data will be improved by actually things like, believe it or not, a massive increase in pension spending from governments.
Yeah, more government spending,
Exactly.
and more cowbell. I mean, more central planning cowbell. For those of you that don't know what that is, now you know. That's when the central bank comes in and says, wow, look at Daniel Lacalle's forecast is accurate. The European slowdown is far worse than any economist in the ECB would have thought. We need to do more. We need to give you more acronyms. We need to give you more, instead of an acronym, let's just call it cowbell. And that's what it is. Do you think that can, because you're just talking about a sequential bounce in data, which can happen a lot. That's not the new trend. It can be a big head fake, by the way, for markets, as you know. But what will this next round of ECB cowbell, what is it actually going to do? Like, are we going to be back into the European economy reaccelerating in the back half of the year?
No, it's very unlikely. It's very unlikely because credit growth in the Eurozone is not bad. Credit growth is not falling off a cliff like we are seeing, for example, in other economies. So it's not a problem of liquidity, and it's definitely not a problem of rates.
Right.
You can get a. I don't want to say this to my friends in the United States that are watching us, but you can get a mortgage in any of the peripheral countries for 1.9% variable rate. Which is insane.
Wow.
So it's not a question of rates, and it's definitely not a question of liquidity. Banks are absolutely doing anything they can to lend. I was given a loan recently. I suddenly received a call out of the blue from the bank. You have 60,000 euros for whatever you want. No, they're desperate to lend.
Whatever you want.
They're desperate to lend. And so it's not so the ECB's problem, which is not dissimilar to the problem of the PBOC and the Fed, is the wrong diagnosis. Is that they believe that the reason why credit growth is low is because of liquidity and low rates, and that companies will and investors and savers will spend more and borrow more if rates remain low. That is not the reason. That is not the reason. Credit growth is okay. Yeah. It is just not okay compared to the Excel spreadsheet of the central planners. That's the only thing which is it's not okay. There is no evidence of any company in the Eurozone. Actually, rather the contrary. If you look at the earnings publications that we have seen in this last month. Of the Eurozone spending less than what it needs. So again, a problem of diagnosis, because the problem continues to be productivity, continues to be overcapacity, zero interest rates are zombifying the economy. Because if in any of the economies in the Eurozone today, you have a company that is not doing well, you go to the bank with the keys of the factory and say, this is, sorry, things are not going well, here are the keys. The bank is going to do anything to refinance you. Mm-hmm. And that's why zombie companies are rising so dramatically. The BIS, Bank of International Settlements, actually showed how the rise of zombie companies is so worrying, because it makes the economy much less dynamic and keeps overcapacity. But it's also that the misallocation of capital between zombie companies that kept being refinanced, plus current spending from governments that incur in deficits all the time basically drive to this massive misallocation of capital that leads to obviously much lower growth, lower productivity, and lower levels of credit growth.
Mm-hmm. So we have the summary of all that is that we have slower for longer. We have the cycle that's rolled over. Everyone knows that now. Just to recap and maybe make a pivot here to tying it into the U.S. view. Just wanted to, and again, disagree if you disagree, please. But again, U.S. economy peaks in the third quarter, starts to roll over in the fourth quarter. The global economy had already been slowing. Europe had been slowing for a year, China for a year at that point. And here we are. Now we have the PBOC cowbell. We have the European Central Bank cowbell. We got the Fed going dovish twice, cowbell times two. And this effervescent hope in the U.S. that the stock market's now actually going up again because that was a one-off, Daniel. That the U.S. didn't really have a classic, really, peak cycle top in equities or peak cycle top in profits or anything like that. I mean, there's differing views, especially because the stock market looks good on a 2-month chart in the U.S. now. Like, where do you wash out on that, where we are in the U.S. cycle relative to what you've already laid out systematically here on the global cycle?
Yes, I think that the difference with the U.S. cycle is that the mechanism of transmission of monetary policy is much better. Mm-hmm. And the reason for it is because
the cowbells are better. The cowbells are louder. They're like we actually have a we're going to get into the Final Four. I know you Spanish guys may not care about Mississippi State, but we got like all kinds of cowbell here in the U.S. This is I could just imagine an Italian or a Spaniard talking about Mississippi State and ringing that thing. But we got the cowbell thing down. I'm a Canadian and I can even ring it here in the USA.
What has got 4 eyes and cannot see? No, absolutely. That is the only thing that is keeping the economy stronger in the United States is the fact that whilst in the Eurozone about 80% of the economy of the real economy is financed through the banking system. In the United States, it is about 20%, and therefore it's a much more dynamic, and therefore you have a bigger process and quicker process of cleanup of problems. But it's a relative game again. It's a relative game again. I'm relatively more bullish on the United States because all the data that we're receiving these days, especially with leading indicators, you have a combination. You have a combination of actually pretty bad one with some others that are actually not that bad. And the reason for it is because the underlying trends are much more different than in the Eurozone and in China. Why? Because the impact of government spending and the impact of government itself in the economy is much smaller. And so I don't think we are going to see a massive improvement in the numbers. And definitely, I'm very aware of the risk that investors, like with China, have some sort of magic expectation about the trade deal. But underlying, productivity growth is better, wage growth is better. Capital expenditure is actually quite poor, but that is not because of anything else than the fact that companies do not need to spend more because the economy in the United States is much more regional, much less externally dependent. And obviously, we talked about energy in the Eurozone. Energy for the U.S. economy is very, very, very important, and the fact that it is now producing as much as Saudi Arabia and that it's becoming almost energy independent is an integral factor of the difference between the United States, China, or the Eurozone to me.
That's an important observation, and it's important to delineate between these economies because they are all very much different. And the expectation that you're going to have this beautifully globally synchronized recovery or whatever the old wall was calling it at the peak. And by the way, that was true back then. It was just that they overstayed their welcome by about a year, and which is not uncommon. So we're on the backside of slowing on the profit cycle here in the U.S., and we're going to get, actually I already have one question in the queue on this, which has to do with your views on high yield, the U.S. debt markets, the profit cycle, et cetera. My view, I think you know this, I think that we're past peak on U.S. Earnings from a rate of change perspective. That was really peaking in the second and the third quarter of last year. And my greatest concern here is that what you should always be concerned about, which is the rate of change relationship between profits and high yield spreads, or the high yield market, with high yield being as exposed as it's ever been. Any thoughts on that and the timing of high yield as a problem? It was a huge problem, obviously, in the fourth quarter. High yield stopped trading, which I would say is, even if Trump called it huge, I'd say it was not an exaggeration. But again, it was a major problem. And I wonder what you think about that in the next 2 to 3 quarters as well.
Yeah, I think that you still have some tailwind on fixed income and high yield as well in emerging market debt, because of the U-turn in normalization policy from the central banks.
Right.
So financial repression is keeping risk disguised, and it will continue to do so, because the tailwind for high yield, I believe, comes from the unfortunate return and rise of the number and the value of negative yield in bonds out there.
Yep.
So basically what is happening is that what central banks are doing is depleting low risk assets from the pool of opportunities for the most conservative investors, and therefore they have to jump 2-3 notches to get a little bit of return, and that is disguising risk. As the U-turn of central banks has caught many of these investors not participating in the market, you will probably start to see, as we are seeing right now, actually, some of those that have seen markets rise in January didn't believe it, in February didn't believe it, in March they say, "Boof, we need to find something to do. We need to do something." Absolutely. That is textbook financial repression for you, because everybody knows, and that you with clients, me with many people, you've had this discussion, is everybody sees the data weakening, and everybody knows the challenges of the global economy, but they see markets rising. And the reason why they see markets rising is because the Fed, the PBOC, the ECB, everybody's done a U-turn. Yeah. So you will likely still get a little bit of a before it gets to the peak of the wave, but it's what I agree with you, it's a very, very dangerous game here, because once this is what happens in the final leg of financial repression, is that massive injections of liquidity have a diminishing return, and especially in the length of the period. So the market cycles become shorter. Yeah. And that would be at least, I think that investors need to be aware of the digression between real data, the earnings, the macro cycle, and the rate and liquidity cycle.
Yeah, that's as important as any point that you've made. Our team can throw up slide 56, which shows that we are indeed going to have the longest U.S. economic expansion in the history of the U.S., which is a long history. That's point number one. So anybody who is bearish, Daniel, going back to, God forbid, 2012 or 2013, when the U.S. economy really accelerated in 2013, would know that there's nothing typical or average about an economic cycle being like 60 months or anything like that. The prior record was 118 months, and we could clean cut get above that without a recession. But you can have multiple profit recessions in between. I guess the next slide is just to point out that what you just had at the all-time highs in August and September in the U.S. stock market was 10 straight quarters in a row of U.S. growth accelerating. That's obviously never happened before. What you have to do to have an acceleration is to come out of a slow slowdown, which has happened 100% of the time, and you had tax reform on the back end of that, which on slide 64, just to show you what it did to earnings, it gave you the highest level of U.S. earnings, corporate earnings in the history of, again, in the history of U.S. corporate earnings, which is a long history, and you got there point to point at its fastest rate. So this gives a tremendous amount of risk to people that are long a chart like that, assuming that it's earnings being the flow through to 10 quarters in a row, or it being this very long, or the longest cycle ever, where the risk is what you think it is, which is earnings come down. And that's I don't know at what pace, I just know they're coming down.
I completely agree. And it's evident also in the trend of, for example, sales growth. Right. Margins are not growing as you would think. So obviously we have discussed the infamous call from so many investment banks that next year capex is going to rise dramatically, never ends up happening. And obviously if you have it's going to be 8 consecutive years of subdued capex growth, it obviously earnings growth is not going to be the same. But I also think that there's another factor, is that last year we reached an all-time high in buybacks. And that was absolutely critical for the performance of the U.S. stocks. If you see the guidance of U.S. companies in the earnings, I think obviously I would say the bullish message into the beginning of the year was that the idea that so many predicated that buybacks would stop in 2019 is not happening. However, the amount of buybacks is a critical part, to your point, that I think people are not taking into account. And I think it's slowing down quite significantly. Yeah,
and the leverage taken on to buyback. I mean, it's obviously, it's a political issue now. I personally have no with that view, but all we know is that it was additive to the earnings growth rate. Guys, if you throw up slide 70, you can, Daniel knows this obviously, but just so that everybody knows what we're talking about, the S&P 500 growth rate, so if you go to earnings growth rate, S&P 500 aggregate, the 3 quarters we highlight in red are now the comparisons, to Daniel's point, fully loaded with tax reform, epic buybacks, the share count obviously falls, the earnings per share rises. That's a new U.S. all-time record high of 24.5% earnings growth that now these companies have to cycle against. So that is the game of chicken that the equity market's playing here, Daniel. And I want to get to some questions, but most of the questions will be surrounding what you've already written about. By the way, for those of you that don't know, Daniel Lacalle wrote this book right here. If you can't see it, so you can zoom in, and please don't zoom in on my chubby face. You can look at, Escape from the Central Banking Trap. So, this guy knows what he's talking about when it comes to this. I know what your questions are. I could see them. You've already asked it 10 different ways. How can stocks just never go down again because we have so much cowbell? And this is, it's not $1 million question, and it's certainly not $1 billion. That's way too low, Daniel. There's a lot more money to be made on timing the answer to that right.
Yeah, well, this is the point. Financial repression is designed for this. It's designed for you to believe that there is no risk and that you can only take more risk. This is it, and that's the reason why Mr. Kuroda buys stocks. He's not stupid, of course. The point is the following: what is your tolerance as an investor for an October, November, December like last year?
Yeah.
Because this is the critical part, is that aggressively low volatility and financial repression will create these types of drastic moves. And unless you have an amount of capital and the ability to sustain these losses, etc., it is quite challenging to be aggressively placed in the highest part of the beta cycle.
Yeah.
I absolutely agree with many people that say, look, if you're out of the market, you have a problem. Is that money is being taken out of your pocket while you sleep by the central planners. So you need to be in the market, but you need to be very aware of the fact that you're living in an environment in which there is a financial repression game, and that financial repression this is an important factor, is not designed for central banks to make you easy money forever. It's for central banks to make governments borrowing cheap. So making governments borrowing cheap does not necessarily mean that stocks are going to rise forever. So you need to be aware of that, and think about this as well. And I've had this discussion, for example, with the European Central Bank. When you present the facts that monetary policy is pumping up asset inflation, many of the members of those central banks will tell you, hey, hold on, but the European market is not going up. Because the key factor is to keep borrowing low, but you're not going to buy Greek bonds and or do so at your own risk.
Do it. Actually, the way Wall Street guys do it is you do it with other people's money, and then you say, we all got it wrong at the same time, but they got paid along the way.
Nobody expected it. No,
yeah,
nobody expected it except Keith and a couple of crazy people.
Well, what we've actually seen, and this isn't the first time, certainly not my or your first rodeo. The economy peaks in 1999, 2000. You have your first market event to the downside, then you get an epic rally from March to May of 2001. Stocks, I think the S&P was up 21%. Credit spreads come in, everything's good, and then all of a sudden, the proverbial poop hits the fan in all different ways for the next year and a half. Including credit spreads widening and staying wide. Then in 2008, the economy slows, Fed comes in with cowbell, first reaction is buy stocks. Then by October, they're down on their knees begging for Buffett to come up with a new sales pitch. it is what it is. It's actually what you said, which is it's about the duration of the cycle and where you we've actually not been, and Darius Dale, my partner on the macro team, says this all the time. We've actually never legitimately been in the U.S. at the late cycle point from a labor perspective until right now. So you've had mid-cycle slowdowns, you've had profit cycles go into recession, but you've not been at the classically, like what I think you mean, and correct me if I'm wrong, but we're real late when it comes to the lateness of the earnings cycle and the U.S. cycle in particular. Absolutely.
So the point for investors is be very aware of high beta bets.
Right.
And follow the money. If you know that, and we all know that the macro data is weak, that earnings and cash flows, balance sheets, buybacks, all those things look peaky. But then follow the money. You see the liquidity trends. You see the what central banks are doing. Follow the liquidity trends. Follow the M2 growth in your screens, and try to avoid staying too long on that cycle. But I think that's what we all have to do, and that's what we have been sort of forced to do, aren't we?
Yeah, exactly. Well, there are a lot of low beta bets that are making all-time highs. U.S. utilities, which I might be the only bull that loves these things, but they make new all-time highs all the time. These are low beta bets. People would call them expensive. There's no hedge fund that's made their career long them. REITs, utilities, gold's working. There's plenty of things that don't have a lot of beta. Gold has a volatility of 10, for God's sakes. It's very low. Anyway, I have just to get to the questions. Why are, and this is an important question. You've done a lot of work on this, if not some of the best work on this. Given everything that you just said, like on the cowbell and the financial repression, Daniel, why are we not seeing global hyperinflation given this amount of stimulus?
Oh, it's very, very simple. You are seeing it. We've just mentioned it all throughout the conversation. We have massive hyperinflation in financial assets.
That's a great point.
That is it. Financial inflation is created where the money goes. Inflation is not created by design. Inflation is created by the destruction of purchasing power of currency. And the destruction of purchasing power of currency is reflected in this case in financial assets. You have massive inflation in financial assets, and what you have is allegedly low inflation, low CPI.
Right.
According to, and remember that Irving Fisher, great economist, created CPI as an average of numerous prices precisely because he was so angry when he saw headlines every day in the paper saying bread is up 20%, sugar is up 10%. And he said, I don't want to see this anymore. Let's bundle them all together in a basket and it will say 3.
Yeah.
And 3 is good.
He's a beauty. He's a beauty. He's a Yale guy. He wears a blue jacket like me. He but then all they have to do after old Irving created the CPI is that they had to change the basket every time components of the basket went up.
That's the other point. But there is a reason, and this is what people need to understand. There is a reason why the economy is slowing down and discontent is rising. All these demonstrations in France are happening because of the cost of living increase.
Yeah.
The cost of living increase is inflation. The French government might tell every one of us that there is no inflation, but there are hundreds of thousands of people out there on a monthly basis complaining about the rise in prices. Therefore, what we're doing is disguising the factors, those prices that are not that are rising too much. With some of them, that are not rising at all. The technology, in particular. The other factor is there cannot be the type of inflation, even if we accept the way that CPI is calculated, which I do, even if we accept the way in which governments present inflation. The reason why inflation does not rise to the levels that they expect is because the economy is not working, the price formation of the economy is not working the way it used to. Because technology is disinflationary, because perpetuating overcapacity is disinflationary, and also because the high level of debt is disinflationary. So it's a liquidity trap, no? Mm-hmm. That's why you don't see that kind of inflation. Now, my dear friends in the United States, if you get one of those lunatics that defend printing money to finance a new Green Deal, you're going to know what real inflation is very quickly.
Oh yeah, then like in 08, oil can go to $150 a barrel on WTI. I mean, you want to do that, you go for it, and then you're going to have both. You're going to have the highest hyperinflation in the history of asset prices on a very short-term basis, which, by the way, we saw in a place called Germany for a very short period of time, and what happened after that is not what people want to talk about. But of course, nobody will be held accountable to anything like that, Daniel, so do not worry. All good. More cowbell.
We will be blamed for the rise in inflation when it happens. They will call speculators because of the rise for the rise of oil prices, speculators for the rise in food prices. Of course, it's always been the same way since the assignats in France.
Yep, no, I agree with that 100%. Just a couple more questions here. This is just to turn the dial to a different topic. I have no idea on this, and I know you do. Any thoughts on Paris, the Yellow Vest movement? Why is this not being reported more often in the U.S. media?
It is not being reported more in the U.S. media because it is a movement precisely criticizing the rise in cost of living in a country that has the highest level of redistribution policies and the highest intervention from government. So reporting about, I mean, obviously, I imagine that they do report about it, but not as often maybe as some would. But the reason why so much of the mainstream media does not like to report about the Gilets jaunes, the Yellow Vest movement in France, is precisely because it is against a government and a country that is presented as the poster boy of redistribution, of equality policies, etc., etc., etc. And what it is, and what the movement is showing, is that all those things are actually not true.
Mm-hmm. Oh, that's one good reason. I can't believe that the media would have any political bias. Certainly not the financial media here in the U.S. Keith, can you ask Daniel what he thinks ahead of the Fed on Wednesday? Do you think the Fed will be dovish enough?
Very good question. I like the term enough. Because expectations are very, very high. I just tweeted a couple of minutes ago some comments from an investment bank in the United States, expecting a very, very dovish message from the Fed.
Yep.
I think that the Fed will be dovish, will downgrade growth expectations, will downgrade inflation expectations, downgrade inflation expectations with a strong labor market, according to the figures that they follow, is going to give them the grounds to continue to be dovish in terms of policy, and even hint at the possibility of not reducing the balance sheet of the Fed, but increasing it. The question is, and the key point of the question is the word enough. And that's what worries me. I think that the market is too skewed to the extremely beta bullish view that the Fed is going to enter into QE. And I don't think it'll happen this time. I don't think it's going to happen even this year at all. I think that if it does, and it might, it will probably wait quite a bit more.
Yeah, that's a really important question for me personally, too. I mean, most of the things that I own are going to have a bad day if the Fed isn't dovish enough. I mean, to be clear, to be clear, everything that's worked for me in the last 6 months is because the Fed growth slowed, inflation slowed, headline inflation, CPI inflation slowed, bond yields fell, and the Fed went dovish twice. I mean, that's the only reason why a Treasury bond bull like me would have gotten paid as much as we've been paid. So if they're not dovish enough, interest rates are going to bounce aggressively in today's day and age might be 5 basis points on the 10-year yield. But still, that's actually how the market's, not to get into what the market's doing today, even though a lot of people care about what's happening today, including me. The market's actually saying that today, Daniel. You don't have you don't have REITs and utilities leading the market to the upside. You have everything else, which is probably that we got overbought at all-time highs on utilities, and Treasury bond yields have been down 14 out of the last 19 weeks. I mean, that is a ton in terms of the consecutiveness of lower for longer on bond yields. Swiss 10s are at, I think, minus 37 basis points. So actually, maybe that's the final question I could ask you here. Is that a catalyst for the stock market to go down, for the bond proxies to go down, and bonds to go down?
It depends. Let's put it this way. If the rhetoric of the Fed points to a problem of inflation, but not a problem of growth, and I believe that they might play around with the 2020 figures, keeping them, then you might see this trend that we have been talking about for a little bit longer, for at least a while longer. So remember that what the Fed is trying to do here is to avoid all of us thinking that the flattening of the yield curve is a sign of recession. What it wants us to see is that it is a sign of the Fed managing the curve. Okay? So the way to do it is to give bullish tone, a relatively bullish tone on 2020, on the communication for 2020 growth, to be modest about 2019, and definitely bearish about inflation. So I'm, I don't know, but I think that definitely the market is too aggressively skewed to the Fed announcing, a big stimulus that first they don't need to. And second, the only thing that they need is to do a little bit what Trump and Xi Jinping are doing with the trade deal, which is to hint that it is coming. So, bear with us.
Yeah, that's important. And, thanks for your honesty on that. There's a book that I was citing this morning. I called it Thinking in Quads, but it was inspired by this book called Thinking in Bets, where Annie Duke, who's a professional poker player, said the 3 words that certified experts or people who perceive to be experts don't use enough, not nearly enough. You just used them in a row. I don't know. All right, so it's a really humbling thing to say, but it's actually the only thing one should say some of the time, and in case most of the time. And I think that's it's a great part about you. It's a great part about following you. I think that everyone is really, it's a great privilege to be able to follow you on Twitter. I mean, these people get it for free. And again, just to have the humility to say that you don't know the answer to every single question, I certainly don't either. That's a great way to end what's been a great discussion. And thanks for making the time to do it.
Always a pleasure, and great to follow you as well. It's always a tremendous learning process. Thank you so much.
All right, thanks. He's Daniel Lacalle. He was first up. Next we have, I'm going to take a quick break here, get a glass of water. We're going to bring in David Root, who runs DB Root. We're going to talk about ways to apply a lot of the 4-quadrant process to money management, certainly in terms of how he's done it.